coming into this earnings season, we were definitely setting up in a bit of a more unique fashion than we had over prior quarters. You don't have to be reminded of the events of December, and you really also can see the rally that we had in the first couple of weeks of January. Although a lot of that rally, I suspect, was as much fear of missing out, FOMO, as was bargain hunting. I think people did not want to be caught underinvested going into a new year, because that sort of puts you behind the eight ball if your competitors have a head start of being of good performance. So you had a very different character this year, and from what we've started to see, I think some of the asymmetry that you see in earnings season when you're coming in off a more sanguine market has changed. What I mean by asymmetry is when the markets are generally healthy and companies are priced highly in terms of price earnings ratios, it doesn't leave them a lot of room for disappointment. And so if companies disappoint on earnings, they usually get, the response is asymmetric. Disappointment is punished much more than outperformance is rewarded. Now, coming into this off the highs, after kind of a brutal December for many, expectations, the analyst expectations haven't necessarily changed all that much, but the market's response to them has. I'm seeing much more of a sense of companies getting rewarded for good earnings equally to punished for negative earnings, and possibly even some outperformance in that regard. I would have said that was very clear-cut last week, although this week, where we've had a couple of days of selling, that response has been a bit more mixed. But in a sense, that's good if you're an investor in individual stocks, because it makes you a little less susceptible to stepping on a landmine here and there. Now, companies that have really, truly missed their number or provided lousy guidance, they're getting throttled. And the market remains uncompromising in that regard, and I have no reason to believe that it won't. But what I think that you're seeing is companies are being rewarded, which is nice. Or if they come in at the number, they're not getting punished either. They're just sort of being benignly ignored. I think one of the things that we saw, let's say, when the banks were coming out, was there was a mix of earnings, and a lot of the top line numbers weren't necessarily great, or bottom line numbers weren't great, and you could blame it on trading results, which are often considered one-offs compared to the basic banking business. So you look at a Bank America, which had a good solid set of returns that were negatively impacted by a bad quarter of trading, and the market tends to look through that. And so that's kind of what I mean, where some of the disappointments where you saw JP Morgan sell off and then rally, or Goldman Sachs sell off and rally, or even as we're doing this today, IBM was rewarded by a good quarter. So I feel that it's nice. It's nice when you can sort of mix in a little upside with a little downside. It makes it a bit easier for investors, a little less treacherous for earnings season. But let's see if the market psychology holds, and if it does, that makes it a more benign earnings season. But if the market psychology turns negative, all bets are off in that regard.